Just to introduce everybody, and in no particular order, but let's start on my far left. Your right is Neil Sauce, who's the chief economist at Credit Suisse, who I had the pleasure of working with for several years in the early 90s, and have not in fact seen for some time. So Neil, it's nice to have you with us. Larry Cantor, who I do work with presently, who's the managing head of research at Barclays Capital, and well known as an economist as well. Immediately to my right is Richard Bernstein, who's the chief executive officer of Richard Bernstein Advisors LLC and was the former chief investment strategist at Merrill Lynch. And then Tony Hughes, who's the director of credit analytics at Moody's Analytics, Inc. So I think we've got a very good panel. Yeah, I thought some of the subjects which they may not touch on in their opening remarks, but which I think are on people's minds. There's the big one, of course. Where do we go from here? Not just in the United States, but on a global basis. U.S., Europe, other BRIC countries, so forth. It seems to me that there's a fundamental question that I hope we will get a chance to get to, which is, has Western Europe and the U.S. been living beyond their means? And are we seeing the beginning, in particular with Southern Europe, largely Southern Europe, people think of it that way, as the first signs of really having to cut back? And we may in fact see it in the United States at some point, but it seems to me that would be a very significant change. Will more of Europe hit the wall? And will the U.S. at some point hit the wall? People talk about aging, and I think there's a panel later on the effects of aging, and not just in Japan, but elsewhere. And I would say the counter to that, in a sense, another aspect of that is the longer term effects of the one-child policy in China, and what that may mean for China, and perhaps we can get some comments on that as well. Protectionism, something that we may talk briefly about. Inflation, the outlook for interest rates, I'm sure we'll talk about. And then one of the questions which I was chatting with Neil about before we started, but which I think is an interesting question. I was in Shanghai week before last, and Singapore last week, and had a very interesting discussion with what I consider to be a very erudite person who about what in fact would happen to the RMB if it was free to trade, with some very mixed views as to what would happen, whether it would go, whether it in fact would appreciate considerably or would not, given the amount of money that might flow out of the country. So those are sort of a few of the things that we can talk about. I thought we'd try to save 10 or 15 minutes at the end to allow people to ask questions if they have them, which I'm sure I would hope that some will. I'm sure you will. I hope you will feel free to ask them. So let's begin then, and give each person a few minutes to make some remarks, and I guess, Neil, why don't we start there, and we'll work around the same way we do with the introductions.
Okie doke, thank you. And thank you for the invitation to be with you today. I want to make 5 points in a sort of a sequence, and if you'll indulge me, I'll try to make it a minute a point. The first point is the cyclical situation. We've had a very big recession. We are, in fact, having a business recovery here in the U.S. and assuredly globally. The growth rate of the economy now looks to be about parallel to the growth rates that we were experiencing before. So in some sense, we're at trend growth. But of course, if you think about it, if you take a big step down, a lot of lost output, and then just resume growing at the rate you were at before, it takes a devil of a long time to get back to where you were in level, and then, of course, make progress from there. And in some sense, there's a permanent loss of output, which is, of course, the source of all economic well-being. So the way we've been trying to characterize this is we're doing better but we're not yet doing well. And it's going to be a devil of a long time. And a lot of the political discourse, I think, is surrounding this question, when will we be doing well? That leads to the second point, which is that everybody seems to think that export is the key to doing well again. And that raises all sorts of issues about protectionism of one sort and another. The form of that is in some sense most insidious, easiest to try to implement and so forth, is competitive devaluation of the currency. And it strikes me that the central banks are going to wind up with close to zero interest rates in the first world and lower interest rates than their economies deserve in the developing world, as everybody tries to resist having their currency go up more than is consistent with getting back to doing well levels of activity. Third point is that all of this suggests that the global trade imbalances that we've worried about for the last 30 years are in fact in process of getting smaller, not larger. If that's so, then the capital flows that go with those, that are the balancing items, will also get smaller, not larger. But for a very long time, we built a financial system around the idea that the financial flows grow faster than the global economy, faster than the local economies. And it's a big challenge to the financial system to rescale and resize itself to a world where capital flows are not accelerating, but rather slowing relative to economic activity. It's a very big challenge to New York in particular, London to some degree, some other centers that you might imagine. Fourth point is that all of that I just suggested says that the entitlement culture, at least in the first world, is very hard to finance. There simply is not enough oxygen, calories in these kinds of low yields to support the kind of pension and health care and other promises we have made to ourselves about our old age. And that is a very big problem, because those promises are often contractual. Nobody wants to give them up. Getting them given up is messy on a good day. The Greeks and others in Europe have illustrated that, and the states in the US are clearly in the front line of that locally. I might add that one of my hobby horses for some decades now is that the 401k is a decidedly suboptimal way of dealing with old age, because it undiversifies all the risks, whereas the pension diversifies them. That's all nice, except that these yields don't allow the pension to function any better than your 401k. To put it bluntly, 401ks turning into 201ks was not a good joke the first time we heard it. It doesn't get better with repetition. And the final point is that for all that we can't afford the entitlement culture, and therefore there's a big transitional issue, the long-run demographics globally actually enormously favor the United States. We have fertility behavior. We have a younger population relative to almost everybody else of consequence in the global system. So getting over this period may be very, very difficult, but the long run is actually much more favorable to the US than to most of the other people who at the moment appear to be swimming better along in this global economic environment. So I'll stop on that note, an upbeat note, rare enough for me, and move the panel along.
Larry.
Yeah, well, I'd love to duke it out with Neil since I'm bigger than he is, but I'm afraid...
You want to change? Should we change places?
Archie's bigger than me. But I have to say, I don't disagree with anything Neil said. I'll just take a little bit of a different tack and we're talking about the global economic outlook. And I guess the way I'd summarize things is, it's clear that economic growth is downshifted from what it was, say, at the beginning of the year. But I think chances for a double-dip recession, this thing you hear about, are pretty remote. So the way I take it is that maybe expectations were a little bit excessive on the upside 4 or 5 months ago, and they're a little excessive on the downside right now. So one of the things we do at Barclays, we have economists all over the world. We add this stuff up, and in 2010, it looks like global GDP is going to register something around 4.75%. We think it's going to slow in 2011, but still be in excess of 4%. Just to give you some perspective, the 4.7% is comparable to the kind of growth we saw from 2004 to 2007 in the boom years. So it's actually a pretty good result, believe it or not, for this year. Now, this is year on year, so it sort of doesn't really weigh the second half of the year very much, but still it's pretty respectable. And in fact, just over the last, I'd say, 3 weeks or so, concerns that this downshift in growth that we've seen is going to accumulate into a downward spiral or a new recession have dissipated a bit. I'd say leading the way in that is China, because China was growing extremely rapidly at the beginning of the year, even an unsustainable pace, probably in excess of 12%. It's kind of hard to tell in a sequential quarter sense because they don't report those numbers. And authorities tried to slow the economy. They have. Everybody was worried because, as we all know, China plays a much bigger role in the global economy, that this slowdown was going to be a little bit too much. But the recent numbers, first of all, they've taken the foot off the brakes. Second of all, the authorities, that is, the recent numbers suggest that the deceleration is sort of over, and maybe growth's even perking up a bit. Europe, if you remember 3 months ago in the heart of the Greek crisis, everybody thought Europe was going to the dogs. And in fact, the second quarter, they recorded a surprisingly strong growth. That's undoubtedly not going to be sustained. They'll slow in the second half. But things have come out in terms of the economic numbers a lot better than people thought. And that's caused less concerns about contagion from countries like Greece and Portugal to the bigger countries like France and Germany. At the same time, Europe's made a lot more progress than the US has, for example, on some of the intermediate term issues like addressing budget deficits. So that combination has made people feel a lot better about Europe. And then if you look at emerging markets broadly, which are a much bigger part of the global economy than they used to be, including China, things look pretty good. In other words, these countries are motoring along. And then one of the big concerns had been that they would start tightening policy. Many countries have, but again, most countries, talking about Brazil, India, Korea, are now saying, because of concerns about the global slowdown, we're not tightening anymore. So that all looks better. The one country where big concerns remain is the United States. Now, having said that, what's interesting, if you go back and look at economic cycles, it's actually pretty typical to see a mid-cycle slowdown. And it usually happens 4 to 6 quarters into recovery, just like we're seeing now. It's also typical for a lot of hand-wringing, lots of concerns about double dip, and for central banks to cut rates, which, with the benefit of hindsight, has often proved to be a mistake. It's actually caused bubbles in certain asset classes. And basically what happens is there's a transition from the initial very rapid growth phase, which is led by manufacturing and inventories, and then that's supposed to go through stronger employment growth, and then services, consumer spending is supposed to go up. And that transition often is a very bumpy one, and in the last couple of cycles it's taken a lot longer than people expected, and hence the hand-wringing and everything else. And so what I would say is, if you sort of step back and think, and this is kind of the last point I'll make, if global growth looks that good, over 4%, why is everybody so miserable? I think one thing is just the context of we just went through the deepest recession since the Depression, where the financial system almost came close to collapse, and seeing, I think Neil made a very good point, and that is that even though growth's okay, the level of activity is not. And the level activity is what unemployment rates are all about, and unemployment rates are the thing that most people feel and most people know, and those are still very high. So although growth's respectable, the reception was so deep that in that context, it's a very feeble recovery. The other point I'd make is that when you look at global growth, what's happened is, contrary to previous cycles, it's not the US leading the world out, it's countries like China and India and Brazil. And so the countries we all tend to focus on in terms of economic data and markets, which is the US, Europe, Japan, are the weakest. And so I think that's also kind of colored things. And then just the last thing, sort of where do we go from here? So we've had, the initial more rapid phase of growth, which was the first 4 or 5 quarters. Now we're in a slower phase of growth. This is not the time, again, if you judge by history, where you suddenly go down again. It's just too early. What brings you down? It's usually either some excesses develop, which have to be corrected, and that's what recessions really are. In certain sectors, in this case, housing and credit collapse, that's a distant prospect because we just did that. None of the cyclical sectors are excessive. In fact, they're all extraordinarily low. Or you get extreme policy tightening that brings you down, and we all know we're way far away from that. So I just say the next phase is more likely to be a reacceleration. The timing's uncertain. Could be a year away, could be 3 quarters, but a little better growth than we're seeing recently rather than a new recession.
Well, good morning, everybody. I'd like to have you pretend that it's 2001 and 2002 instead of 2010. And if we were sitting here in 2001, you would have been saying how strong the US economy was. You would have said, well, the technology bubble has burst. But you would have been talking about the problems in Asia. If you remember, we had come out of the 1988, 1999 Asian crisis, Russian crisis. You would have been very concerned about the emerging markets, and you would have, number one question on your mind in coming to a forum like this was, what's going to happen to technology and what's going to happen to the bubble and things like that. You would not have actually sat here and said, I think the great opportunities in the world are in emerging markets. That would not have been on your mind. At the same time, you wouldn't have sat here and said at that time that we have to worry about things like commodities and commodity price inflation and things like that because the dollar was exceptionally strong. If you remember going through the late 90s, the dollar was very, very strong. And so things like commodity prices rising would have been the last thing on your mind back then. And so here we are, it's now 10 years later, and think about how sentiment has changed. We now think the US, if you pardon my phraseology here, the US economy sucks, right? The dollar is toast, it is never coming back. China, Brazil, India, maybe Russia, if you're generous, you're going to say these are the economies that are going to lead us in the next decade. And that may be true. Remember, I'm more of an investor than a formal economist, and it may be true. But let's think back about what people said about the technology bubble and the economics of the technology bubble, and everything they said has actually come true. Right? If you think about the role the internet plays in your life today versus 10 years ago. It's a dramatic change in the way we do business. It's a dramatic change in the way you run your life. If you have a smartphone, that was part of the technology, that was the economics of the technology bubble. Digital convergence. You were supposed to have something in your pocket where you could do everything on one device, and that would probably be your only device. That has happened. But if you invested in NASDAQ in 2000, today you would be 60% below the peak of NASDAQ. So my point is that the Chinese economy may dominate, but as an investor, I honestly don't care. It's not that important to me as an investor. What I care about is the valuation of the assets that I'm buying in those markets. And I will tell you, the valuation of the assets in those markets are extraordinarily expensive, outrageously expensive. Right? And if you view the BRIC countries versus the rest of the world, you will see the world is exceptionally expensive. Now, I agree with Neil's final point. I actually think, and I'm no flag waver by any means, I actually think the best opportunities are actually in the United States. If you think about where there is a scarcity of capital in the global markets, there is no greater scarcity of capital than small businesses in the United States. Right? That was true 12 years ago in the emerging markets. It was true 10 years ago in commodities. It's not true there anymore, right? I mean, we've had record flows into emerging market debt and equity mutual funds. The biggest IPOs known to mankind are now Chinese banks and Brazilian oil companies and things like that. By the way, nobody's actually looked at the Petrobras deal that's supposed to come. But if you look at that deal, that is 20% of the market cap of BRIC investments in mutual funds. That's how big that is. Right? So is there a scarcity of capital in the emerging markets? I don't think so. The scarcity of capital in commodities? Hardly. Right? We now have financial buyers of commodities. So where is there a scarcity of capital? We all know it. It's small business in the United States. They can't get capital. And I think that is maybe not quite what Neil was saying, but I agree with the underlying theme there. I think that's going to be the great investment story in 10 years. And if we come back here in 10 years, we're going to be talking about the resurgence of the U.S. economy, how resilient the U.S. economy is, how small business is the place to be. Wall Street will have huge small cap research teams, which they've gotten rid of in the past 10 or 15 years now. You'll hear a lot about special situations analysts. Remember those names? They'll come back and all that type of stuff. And I will bet you that Wall Street will be cutting back at the emerging markets. So I look at this very, very differently, just looking at the sentiment and the valuation of the assets and what people are saying. I don't quite know what. I'm not a formal economist the way my colleagues are here. But something's going to change in the next 10 years. The second thing I just want to point out very quickly is last week I wrote a commentary article in the Financial Times that basically talked about how US monetary and fiscal policy is leaking abroad. And I think this is going to be a very big topic over the next several years, especially as we head towards the 2012 election, where I don't think that Washington, if you talk to people at the Fed, they'll say, oh, our models have all these international variables in it and everything like that. But even in 2002-03, when I was at my former firm, we wrote a lot about how the Fed bringing interest rates very low at that point, which was not zero, but it was like 1%, that was effectively giving free money to China. That would be the impact. It would give free money to China. And I still don't think that Washington appreciates that things like cutting taxes, and this is not meant to be political, don't listen to my point, but cutting taxes when you have a weak currency invites capital flight. The effects will be felt outside your country, not in your country, things like that. I think this is going to be a very big issue. Some people may call it protectionism. I'm not quite sure that's the right phrase to use, but I think in Washington over the next couple of years, especially as we go towards the presidential election, you'll hear more about making sure that policy is felt here in the United States as opposed to around the world. And I think that's going to invite an immense amount of populist rhetoric on both sides of the aisle as we go forward. We're seeing it already, where we have the Tea Party and we have the left-wing equivalent, which is actually kind of quiet right now, but was quite vocal a couple of years ago. I think we're going to see both extremes get louder and louder and louder. I think this is an environment where the center is really not going to be heard, for better or for worse. There's many investment implications along with that, but I think that's something that everybody should look out for as well. So I'll stop there.
Tony.
Hey, thank you. I'm Tony Hughes. I work with Moody's Analytics. I believe that my esteemed boss, Mark Sandy, is due to take this place today, but unfortunately he's testifying before Congress, so hopefully you can forgive him for that. I would say it's very difficult to follow three such esteemed analysts. I know, Richard, you don't consider yourself an economist, but you sound like one to me. But nonetheless, I think if I could characterize my view relative to the other speakers, I'd say that I'm more pessimistic about the near-term outlook, although I agree in general about the longer-term view of the demographic trends in the United States relative to some other parts of the world. The reason for my short-term pessimism is because I feel that the US is still the driving force behind the global economy. So I think that China is looking increasingly like a second engine of growth in the world, but I don't think it's fully engaged yet. And I don't think that China and East Asia in general has the the consumer base to actually pull the US and Western Europe out of the economic mire. I'd say that the US consumer, by contrast, is currently pushing around two very large boulders, I would say. One of them is very high unemployment, and the other thing is a massive asset price deflation that's taken place over the last few years. So I think that the lessons of Japan over the past 2 decades illustrate that it's very, very difficult to have such a sustained and large-scale decline in household wealth without it having negative feedback effects on consumption in the short term. I think that the double whammy for the US, however, is, of course, the large run-up in unemployment, which was never a feature of the Japanese economy over the last couple of decades. I think the other main problem in the US at the moment is that the Fed obviously is liquidity trapped. So its ability, obviously, at this point in the cycle, under normal circumstances, the Fed would be, talking up the economy and making perhaps small, adjustments to monetary policy, usually in a downward direction. So as the recovery starts to look increasingly fragile. But in the current environment, obviously, they can't do that. And so that really means that that fiscal policy in the US is really the only arrow that the government has left in its quiver. Unfortunately, fiscal policy at the best of times is not as sharp as some of the other potential arrows that are out there. But nonetheless, if it's the only one you've got, you want to fire it. And I think that, as Richard alluded to, I think that the political will to engage in that type of fiscal stimulus is minimal or non-existent. The Fed being liquidity trapped, its main sort of effect that has on policy is that if anything happens in the world, then the Fed is really powerless to do very much about it. So we saw with the European debt crisis last year that really the economy was starting to gain traction prior to that, and it looked like the recovery was going to start to become self-sustaining. The European debt crisis, which was completely outside the Fed's control, occurred, and the ability of the Fed to respond to those events was negligible, and that had the effect of, I'd say, partially derailing the latent recovery. So going forward, I'd say that I would attach a higher probability of a double-dip recession in the US. I think that outright deflation is a real possibility, and I think that there's very little that the policymakers can actually do about it. Currently, my boss, who is largely in charge of our forecast, puts a probability of double-dip recession at about 1 in 3. And I would say that it's slightly higher than that, although I would still say that it's not the most likely outcome. Thanks, Archie. I'll stop there, I guess.
Well, that's a bit of a more pessimistic view than some others, but that's all right.
Sorry.
I think the question is, I think both of you, Neil and I, felt that the chances of a double-dip recession are quite small. It seems to be more of a concern to people today than it was. But would you be of the view that it seems to be more in people's minds, but in reality, not particularly likely in your views?
Yeah, I mean, I just say that to some extent, I think it's a bit of a red herring in the sense, I'm not sure what people mean. If they mean a new recession, I mean, remember, recessions are, the stock market goes down 50%. You get at least one cyclical sector absolutely collapse. Take U.S. housing, went from 2.3 million housing starts to 500,000. That's what happens during a recession.
And you get negative GDP.
Well, that's why you get negative GDP, because a whole bunch of stuff in consumption that just rolls along. Getting haircuts, healthcare, which is a seventh of the thing. So you need some major collapse. Now, the thing is, tell me a sector. If housing starts went to 0, single-family housing starts went to 0, which is not possible. That's 0.6% of GDP. Well, they pretty much have. 500,000 is 0. It is 0. That's the point. Whether you go to all your capex, it's so low. That's what I was saying before. There are no what are recessions? They're corrections for excessive behavior. That's what they are, every one. And I don't think anybody in this room would have difficulty identifying some excessive behavior that occurred in 2006 and 2007. That's what they are.
And they're almost always accompanied by credit restriction.
Well, this one was a real credit boom bust.
But most are restricted.
Oh yeah, they're always in recession. So now, but if what people are referring to is what people call a growth recession, which is where growth downshifts to a below trend pace, and actually there's many esteemed economic shops on Wall Street calling for that now, where the economy is growing 1%, 1.5%. That is, I would say, does have a 30-40% probability, which would be awful because the unemployment rate starts going up again. It edges up. It doesn't go from 4 to 10, but it can go from 9.5 or so where it is now to 10 or 10.5. And that would be awful, given how high it is now. That's a growth. So when we say the chance of recession, we're talking about a recession in the real, things
Right.
collapse. And again, at this stage of the cycle, it's just very, well, let me put it this way. Some new bad thing would have to happen, that you can't fork, some awful thing that just, something happens in Iran, for example, oil goes to 150. I mean, we could all conjure up some terrible thing happening that all of a sudden, wham, and you start, but it won't happen sort of endogenously.
Can I just make a comment on that?
Let me just
so,
add that, your forecast right now has unemployment going up to 10%.
That's correct. Yeah, I mean our current U.S.
That's a growth
forecast
Right.
is for I mean our baseline forecast at the moment is for continued growth and no double-dip recession. And under that scenario, we still see unemployment dipping up to about 10.5%. But I mean, my response to your comments before would just be that Japan had 5 recessions in 15 years, and I think that you could attribute, well, the most recent one was obviously because of the global economic events that were taking place. The one in 1997 can obviously be attributed to the Asian financial crisis. But you've sort of still got 3, fairly, serious recessions taking place within Japan over a decade. And I would argue that none of those 3 were were caused by build-ups of excess in the economy. They were just caused by malaise, by general malaise, and having a impotent central bank that was unable to do anything to staunch the flow.
I mean, I don't know
Yeah,
if you want to say, but I'd love to get into the Japan-U.S. comparison. I just don't think it's irrelevant.
Yeah, no, I am more sympathetic to the view that the economy, having been very non-cyclical in the U.S. for the 25-year stretch, let's say from 1982 to 2007, is now going to be more cyclical. We're going to have more frequent recessions. I think that the Great Moderation, as it's called, was the result of the credit easing over that period, a secular increased access to credit on easier and easier terms, not just interest rates, but eligibility to borrow, assets that could be pledged, and so forth. Home equity lines of credit did not exist until the early 80s. The outstandings were 0 and then became $1.5 trillion in no time flat. That allowed people to smooth their spending. And that's what kept the economy from being as cyclical as it previously had been. And I don't think there's much question that whether because of our own, what shall I say, attack of prudence in the aftermath of last year, or the regulatory's imposed prudence, it hardly matters why, we're not easing credit in that sense anymore, not for a stretch of time. And that will make the economy more cyclical. I grant that readily. And again, I much in the spirit of Larry's observations, would tell you that this double dip business is a largely semantic issue at this moment, in my view. Because the slowdown scares, which are absolutely normal, feel scarier in an episode like this for 2 reasons. First, because the starting point is a poor level of activity. And second, because we've already used a lot of policy, and there's a sense that maybe policy is not as potent as it would have been, was, you'd like it to be, pick your words. So slowdown scares will be more frequent and scarier, which is not quite the same thing as the economy will actually slip into a new recession. And I am mindful that this is a distinction that Larry and I can enjoy as economists, and most of you think is largely semantic.
Yeah, I don't think that's a long way away from my assessment, frankly.
Have we, you spoke of the home equity loans, and obviously we had huge increases in credit card balances and other forms of lending and so forth. Let's go back to the question of has Western Europe and the United States been living beyond their means?
I mean, I'd say yes, but
And what are the consequences going forward?
yeah, I think we're seeing them. Take the U.S.
But will we continue to see them for
For a while,
For how
yeah,
long?
I would say that. But let's talk about the U.S. consumer, because you referred to the U.S. consumer and what is going on there. There already has been an enormous amount of balance sheet adjustment in the U.S. household sector. I mean, we had a saving rate that, depending on the measure you use, was either 0 or even negative. Again, depending on the measure you use, it now looks like it's over 6%. That's a big move. And not surprising, given what happened, as you referred to the asset, not only the values of the assets, but the perception, I think, is maybe even more important. Since World War II, most Americans thought of their houses as a store of savings. It just went up every year. There was not one year where national home prices did not go up until 2008. Never happened. Never went down. Of course, so naturally, I mean, Americans thought, well, I own a house. This is going to go up in value, and hence they saved less, which made sense when it goes up 60 years in a row. Whatever it is, pretty good bet. It's going to be. So not only have house prices fallen, which we all know, but I think the perception in people's mind that this house is going to continue to grow in value has changed. Everything you read, everything you hear, it tells you, you know what, I can't count on that anymore. And therefore, I'm going to have to save. I can't count on my house. And I think that is ongoing. I think there's been a lot of progress already, the saving rate, but we're not going back to a 0 saving rate, and that's going to keep consumer spending weaker than it was before. How weak? It's been running about 2%. By the way, it looked like 2.5, 3 earlier in the year. Now it's been steady at around 2%. By the way, that's a terribly low pace after a recession, especially. It's very, very weak. Look at car sales. I mean, they've come up 20%, but they're still way lower than they had been before. And that is going to continue to exert a drag. But one big difference between Japan and the US is, one is these adjustments are much, much faster than in Japan. Look at the banks. I mean, we didn't even know, for 5 years after the real estate and stock market collapse in Japan, not only didn't banks make any adjustment, but they hid from everybody what even was going on in there. Everybody was dying to find out what's going on, instead of the stress tests and everything else, and all the write-downs that's already happened in U.S. banks. We had nothing in Japan for 5 or 6 years. They didn't even begin to address it. So that's what. But the biggest difference probably is Japan is a country that had been and still is very dependent on exports. The Sonys, the Toyotas, the Hondas, and allowed, you can call it allowed or whatever, saw a massive appreciation in the currency from over 350 to the dollar to 80. Look at the U.S. I mean, Richard was talking about where the dollar is now. I mean, it couldn't be more different, both in terms of the dependence on the sector. So Japan never transitioned to a more domestic, demand-oriented economy. China's trying to do this, by the way. China's not following that way. A, they're resisting currency appreciation. B, they're actively trying to focus on less dependence on exports. Japan never made that transition, and it's killing them still today. That's deflation. That's slow growth.
Just a couple of things. Larry's right. The savings rate is huge. I mean, that's a big one. And one of the things that we're looking at very closely is just going back to the basic idea: savings equals investment. We would discuss that at length. But the question in our minds is savings equal investment here, or is savings equal investment someplace else? If our savings flows to China and investments in China, it's not going to do anything for us here, which I think is one of our concerns. And number two. Although I know it sounded bullish, now it sounds bearish, but one of our other concerns is that the United States is starting to look more and more like Bermuda. What I mean by that is that we have a lot of companies domiciled.
That's an interesting.
Yeah.
Global warming.
That point of view, we're not, right, we're all going to wear the shorts and the silly socks, right? And but what I mean by that is we have a lot of companies domiciled here, but they don't actually do anything here. And that is a major issue. If you look at corporate profits as a percent of national income, it's almost back to its all-time high, which was set 3 years ago or so. But yet the household sector is still suffering. And that's why I think you're going to see the political rhetoric be huge. And I think multinationals may be the bad guys. If GE or Merck or somebody builds a plant in Botswana, that's not going to be viewed very nicely in Washington. Increasingly, and I think those are two things we're looking at. Where's our savings going? Is it staying here and lowering the cost of capital in the United States, or is it lowering the cost of capital in Botswana? And second, are corporations that becoming more and more almost I won't say Japanese, but almost Japanese, because in Japan they're such exporters because they produce everything there. We don't produce anything here. but our companies are domiciled here. The corporate headquarters here, but nothing else is down here. So in a way, there's a little bit of a Japanese analogy there.
Yeah, I mean, I'd actually like to get it back onto the original point, if I may. But in terms of the living beyond their meansness of Western European and American consumers, and like I do follow the consumer credit markets very closely, and the interesting thing is that certainly in revolving credit products in the United States, credit cards and home equity lines typically. These have actually been performing very well of late. So the delinquency default rates are actually below their long run averages. And so this would suggest that the US consumer, at least in terms of those products, is actually doing reasonably well at the moment. Part of that, though, of course, is because of the sort of the institutional structural change that took place in that people became more willing to default on their mortgages over the past few years. And a lot of the balance sheet readjustment that we've seen over the past couple of years can actually be attributed to defaults on mortgages. And if you remove that from the equation, it turns out that that American consumers have only adjusted the expense, the debt side of their balance sheet by a very small percentage. So I would say that there is evidence that certainly the revolving credit companies in the United States have actually been very responsible over the past few years. They've reduced access to lines appropriately during the recession, and American consumers have really followed along with those plans.
We're talking about the consumer and overspending, living beyond its means, but we haven't talked about municipalities, counties, states, and the federal government.
Well,
and what impact does that have as we go forward? Because clearly they can't continue to live beyond their means anyway. Most of them have mortgaged almost everything there is, including future toll payments on highways and everything else. I mean,
Worse yet, tobacco revenues. And then they don't want you to smoke in Central Park. It's quite remarkable. Never heard anybody doing something like that as a policy matter before.
but I mean, they really have. Cities and states
you
and
bet.
counties have mortgaged future cash flows to finance current expenditures.
That's correct.
We can't keep doing that. I mean, we've been living beyond our means there too.
Yep.
What's the,
Well, I'll tell you, there's a
what's
couple
the
of things.
impact of that long term?
One already.
Other than higher taxes.
Right. Already, you're seeing this in the municipal bond market, where municipal bonds used to trade. If you looked at them in a portfolio, if you looked at diversification or anything else, municipal bonds actually traded very much like treasuries, right? And I think it was the appropriate relationship to say, what is the spread versus treasuries for them, because they were basically one and the same. Right now, the only munis that trade like that are pre-refunded munis, which are basically, pre-refunded with treasuries. So there's no risk of default, and they actually look like treasuries. But there's about 3 of them that you could probably buy at any point in time. They're very scarce. Even if you go to AAA treasuries or AAA munis, you begin to see economic sensitivity into the way they're trading. Nobody trusts the insurance anymore. Nobody trusts the ratings, with all due respect to Moody's, but nobody trusts the ratings. So you actually see that even AAAs are trading with some economic sensitivity. And the market's very efficient. As you go from AAA to AA to single A to triple B, you see more and more economic sensitivity trading, moving into their trading patterns and their correlations with other assets. So the markets are on top of this, and I think that's right. Now, what does it mean? It means, again, you have disgruntled voters. I mean, I think that's...
Well, let me suggest something that it means that I don't think people have paid enough attention to yet. And that is that when you raise property taxes to fund a pension plan, which is paying for school teacher services that were rendered 20 years ago or 10 years ago, you're getting no new current service to raise the value of your house, but you're getting a tax that pushes down on the value.
Right.
So the ability of the housing market to revive is restrained, to put it mildly, by this phenomenon. It's not uncommon nowadays to find your neighbors complaining that their property taxes are bigger than their mortgage payments. Housing, by any other metric, is the cheapest asset in America at the moment. Housing prices have come down, mortgage interest rates are very low, and so forth. By all the traditional metrics, we ought to be having a big revival in housing. And I think one of the restraints, clearly credit standards, clearly unemployment, all are restraints. But I think one of the restraints that doesn't get the attention it deserves is the state and local funding problem, which will manifest itself through that asset class. And people will wonder, well, why is that? Well, this is the mechanism, and I think it's real troublesome. But just a quick point. You asked if Western Europe has been living beyond its means. The answer is no. Which is, Western Europe, after all, is in a current account balanced position with the world, taken as a whole. The periphery has been living beyond its means, but funded to a considerable degree by the core. That is a bit like the New York versus, or the Northeast versus the Southeast experience that the US had from the decades, let's say from the 30s through the 70s or 80s. A big shift of economic performance and so forth regionally. We did that with a single currency, and my bet is Europe will succeed at doing it with a single currency as well.
I just want to make one point on the finances you mentioned, Archie, and that is that, I don't disagree with anything that everybody said about it, but it's also worth recognizing is that that's what's supposed to happen relative to the business cycle. In other words, after a recession, there's a massive shift from private sector debt to public sector debt. The size of that shift is directly correlated with how big the cycle is. Mm-hmm. We had a massive recession. We had and not only that, but this was a classic credit boom bust recession, which to me means you're going to get a much bigger shift from private sector to public sector debt. Now, that said, what's supposed to happen later is that big public sector debt will act as a restraint on growth going forward, because governments, whether it's state and local, federal, are going to at some point have to address this, raise taxes, cut spending, all the rest.
That was my question.
Exactly.
What impact is that going to have?
It will restrain growth, but at some point you would expect, Neil just spoke about how cheap housing prices are, and there's a lot of factors that are restraining it. The stock of foreclosed homes still coming to the market and all that. But eventually it will go back. The demographics say housing starts should be between 1.5 and 1.7 million. They're running 500,000. Now, admittedly, they peaked at 2.3 million, and we've got to work off that excess. But that will happen. The second point I just want to make more generally, I think Richard made a great point, and that is we're all opining here on the economies and all that. That is not the same as markets. In my current job, I'm running the market strategy, not just the economics. It's a very different thing. And Richard's exactly right. You can have, and in fact, if you look today, yes, growth is very sluggish in the U.S. economy, but conditions for financial markets look great. The Greenspan puts become the Bernanke put. Basically, if things get rough, we're going to inject even more. Is anybody, what are the things that stop recovery? One is tightening. Does anybody think we're going to get monetary tightening in it? Zero rates is a very powerful thing for financial markets. You finance yourself at practically zero, and your alternative to a risky asset is paying nothing. Anybody who's got money in a money market fund can tell you, you get nothing on this, and that's a very powerful incentive. So, and you're mid-cycle, nothing horrible or great's going to happen. That's a pretty good scenario for. And look at it, I'm sure Richard could speak better than I can, the relative valuation of stocks versus bonds right now is at extreme in favor of stocks. Are incredibly cheap relative to bonds. So I think this distinction Richard brought out is exactly right. What you say about the economy is not necessarily translate directly into...
I'll go one step further. The U.S. stock market is, in our work, amongst, I'm not saying the most, but amongst the most attractive valuations in the last 50 years. If you think about a 2.5% 10-year and 1.5% inflation rate, what is the correct multiple on the S&P? By our models, it's roughly 20, and on trailing earnings, it's about 15 right now.
Right.
So if you don't get 5 full multiple points, you get a couple multiple points. That wouldn't be so bad.
Have you done comparable work for the Nikkei, just for curiosity's sake?
Nikkei, well,
they too have zero interest rates, and their stock market.
The thing is that there's a group out there that the ultra bears that would argue that what's going to happen is that we're going to have deflation in the United States and the multiple is going to collapse in the United States. The multiple in the stock market will collapse because people will just completely lose faith in the system. And that didn't happen in the 1930s, and we had monstrous deflation. The deflation we're talking about here is nothing compared to what we saw in the 1930s. Didn't happen in the 1930s. And what should happen if interest rates go to zero, really go to zero, is your multiple should go up exponentially. And that's what you're seeing in Japan, is that the multiple has gone up exponentially, and it's sitting at like 40 with a 50 basis point, I don't know what the 10-year is there now, but is it 50 basis points?
No, it's a percent at the moment. but
Percent.
Give or take,
About a percent.
give or take.
But I mean, that should happen. That's exactly what should happen. Because earnings depreciate more rapidly than stock prices.
Let's open it up unless people have anything else to add. Should we? Let's open it up to questions. I see 2 hands, 3 hands already. So go ahead.
Hi, my name is Ellen.
Hold on just a second. I think we're going to pass the microphone around so everybody can hear. Thank you. It's not on. Is there a switch on it or not? Now try again.
Yeah, just.
My name is Ellen Easton, and Richard, I would say, if I agree with you, we'll both be wrong. But basically, not really a jest. I think we could all agree it's indisputable fact that without social programs in place today, this recession would in fact be a depression. So sometimes less is more. And I think instead of, this is my unprofessional opinion, that raising taxes on the consumer cuts to the core of what our country's foundation is of basic services and goods. And if the average consumer doesn't have money in their pocket to support services and goods, we don't really manufacture that much here today to export. So why would the offshore, this is where I'd like all of you to address the question, less being more, instead of sheltering major corporations with tax avoidance, why not have a very, very low minimal tax under 5% across the board, non-negotiable, to every single corporation, foreign or domestic, that chooses to have tax shelters offshore and avoid it, and just say it's like a toll tax. Go offshore, do whatever you want. You don't have a big, big penalty. They don't feel the bite that much. And we bring in billions, if not trillions of dollars to our federal government, which are then allocated into a pie for social programs, entitlement programs, which give back to small businesses, that puts money back into the consumer pocket, lowers our tax burden for the schools on the houses because they have the stimulus program. And it puts money back into my pocket, and I can go to the store and buy something, which promotes another small business. Why can't it just be less complicated without all the numbers being manipulated?
I don't know. I'm not an expert on tax policy. I'm not sure I actually suggested that it was going to be complicated or anything. My point about tax policy is simply that I don't think that Washington realizes that when you have a weak currency, if you cut taxes, you invite capital flight. That's my only point that I was trying to make before, and I think that's very important. I don't think it's been realized, and the way I would look at it, and again, I'm not being political here. These are the numbers of the numbers. This past decade was the weakest decade ever for real investment in the United States. Ever, and that was post-tax cut, and the tax cut was supposed to stimulate investment here in the United States. That was the original argument for it. It didn't happen. In fact, in some areas it accelerated downward. So my point being, I'm all for tax cuts, but I think the discussion that's been going on misses the point as to whether the tax cuts were actually effective in the first place and what their stated goal was for capital gains. I'm not talking about individual, I'm talking about capital gains. I'm sorry, I should have said that. I don't think they were effective. They might have stimulated investment in emerging market funds, but if I'm a policymaker in Washington, is that what's important to me to stimulate investment in overseas? I don't know. So if it didn't do what people thought it was going to do, my point simply was that if you let the tax cut, the capital gains tax rate expire, it's probably not going to have the effect that people think on U.S. investments. Where it is going to have a big effect, my argument was on non-U.S. investments. Non-emerging emerging market ETFs, non-U.S. mutual funds, things like that, because that's where all the capital gains are. And that's where I think there'd be some risk.
I just want to make 2 quick points. I have a little disagreement. One is that at this point in the cycle, I think it's a big mistake to raise any taxes. I just think, and I also think
But
that
partly for psychological reasons.
partly concerns about tax policy right now, I think, are one of the factors that's holding the economy back. So I think right now is not the time. And we can argue politically whether taxes should go up on wealthy individuals. I would just argue, A, they account for a lot of spending, which affects employment, and now is not the time. So the second thing is, I think you talked about complication. I think I'm hugely in favor of tax simplification. The amount of resources going to figuring out taxes. I mean, our tax system right now makes no sense. It's basically a series of Band-Aid approaches over many years through many Congresses that does not hang together. I mean, I think they should eliminate the whole thing and start over again if you want a sensible. So the amount of resources that goes to figuring it out, avoiding it, and the unintended consequences are unbelievable. I mean, if that's part of your point, I couldn't agree more.
I must say, like, as well, just in terms of your specific proposal, in terms of reshaping the tax system, to me that sounds a lot like what's called a Tobin tax, which is a tax on all foreign exchange transactions. And I mean, I think that's been debated.
I mean, you can't take a company like Halliburton that goes to Dubai and incorporates in Dubai when it was originally a U.S. company, and now they're avoiding how many gazillion dollars in taxes, and then
The Tobin tax would catch them to an extent.
I mean, I don't think it should be foreign. I think it should be domestic as well. Any company that is incorporated offshore and conducts business here through importing or exporting, make a little toll tax. Nothing that burns their pockets so drastically they don't want to do business with us.
I think it's a point of view. I'm not sure we're going to solve it here. I think we should turn. I think there's another question over here. If we maybe could pass the mic over.
It is working, yeah.
Yes, it is.
I would like to bring some real world situations into this discussion because, you know, having a bunch of economists talking about interest rates and currency valuations and so on, and pretending, and excuse me if I'm going to be critical, that this is business as usual concerns me. The other thing that concerns me is everybody seems to be agreeing. I wonder what would be the form of the discussion if Rubini were here. So here are the real world points that I want you to consider. We are living in a much more global world, and you know the interaction is going to, of the various events and so on, are going to shape our economies. And 4 things I want you to consider, which I characterize as real world. Number 1, the impact of wars. Now, we're talking of events which have the impact of trillions of dollars. So we're not talking of small money. And somebody mentioned in passing the possibility of Iran, and it's very much there. I mean, we're not in the prediction business. We don't know whether it's going to happen or not, but we've seen what's happened with the wars, and every day in the newspapers there are prospects of the wars going to happen. Secondly, the environment. Do we factor in the enormous costs and the burden that we all have of the environment? The oil spill, the floods, you know, huge amounts of costs that are being borne by everybody. We just can't ignore, you know, it's happening there or here, it's even happening here. Thirdly, poverty. And, you know, the rich are getting richer, the poor are getting poorer, and there's enormous poverty, and the United Nations is unable to achieve its own projections for the millennium. surely that's again something that's going to have a huge impact on the way our economy is. Fourthly, and this is an invisible factor, and I mean, Larry talked about excessive behavior. This is what it is. This is excessive behavior. Ethics. We haven't come to grips with ethics, or the fact that the present crisis may have been caused by a lack of ethics, and that the system that we have is infected, and whether we have resolved it or not. So, 4 real-world issues that I wonder if we have factored into our calculations, and if we did, how would you look at them?
I'm not sure who wants to tackle that. I think a sort of a broader question that gets at some of them, but not at the environmental cost questions and not at the ethical questions. The ethical questions I have some particular sympathy with, for perhaps, you know, I hate to be critical of a single individual, but when you have a Secretary of the Treasury who didn't pay his income taxes, it seems to me that's a bad sign. Let alone what goes on in Washington. It's inconceivable to me that the United States would have come to that point in time. But a broader question that relates to what I think you're saying is that ignoring the environmental issues, which you do have huge costs, is in a global economy, and this is a question I think that is an economist type of question. In a global economy, aren't we destined in the long run to having more of an equalization of income between countries than we've had in the past? And doesn't that bode poorly for the wealthy countries, in relative terms, poorly for the wealthy countries versus the developing countries?
Yeah, I'd say
Yes and no.
Yes and no. I mean, actually,
Yes and no.
It's
Two
a
questions.
It's a healthy.
Absolutely.
It's a good thing. In other words, countries coming out of poverty. And by the way, on your point on poverty, take a look at China. Enormous improvement in per capita income and people in poverty coming out of poverty. I mean, amazing. How did it happen? Trade. People seem to think this is a zero-sum game. It's not.
No, it's
China coming out of poverty is good for the United States. It's good. It is not a zero-sum game. It creates more wealth in the world. The big problem with that, I know it was a big risk of that, is protectionism. That's how that doesn't happen, and it hurts everybody. It's a lose-lose situation. Trade is a win-win.
But protection is a risk today.
Definitely. So obstacles to that, where you don't allow countries like China to come out of poverty, is a lose-lose situation.
Let me just ask a question. I mean, this is an investment theme that we've been looking at for a long time. How would you then describe, if it's a win-win, that the disparities of wealth in virtually every country around the world are getting wider?
Well, that's a different issue. That's in other words, the distribution of wealth is a different. That's a different. That's a different issue than, you know, countries coming out of poverty.
I agree.
And you know, think about it. And everybody says trade's bad for the U.S. because we lose manufacturing jobs. At the time of the American Revolution, over 90% of the citizens in the United States were farmers.
That's right.
Now, there was huge political pressure to protect that, and there still is, but you know, we don't want to change people's lifestyle, and it is a social issue. If that was true today.
That's why we still subsidize them.
Right, but if more than 90%, we could have had social policies to prevent the change and move to the cities and all the rest, we would be a poor country today. Right now what's happening is the return on education has gone way up. In other words, it used to be, even as recently as 20 years ago, you could be on a factory line and make a very good living, have a great retirement and all this. It's not true anymore. Is that a bad thing or a good thing? In other words, now you're much better off getting educated, learn about technology, learn about financial services, legal services, or whatever it is, or insurance. You know, because the manufacturing base is going down. That's what happens. That's progress. And it's good. So now a lot of the manufacturing jobs are going to places like China, to India. That's lifting these countries out of poverty, which is causing them to spend more and allowing us to export things like financial services and insurance services and technology and all the rest. That's a shift. Does it have medium-term social costs? Absolutely. I mean, it's not easy for people to transition, in areas like Detroit out of the manufacturing and into things like services, but it's how we progress.
Well, just to follow up, I don't agree. Here are the numbers. In the United Nations program, what they hoped to achieve was reduce the number of people who are below the poverty line by 300 million. They failed miserably, and in fact, the actual impact is that the increase in poverty has been by 85 million people. So instead of going the other way, so the impression you're giving, yes, there are people who are improving, like in China and India, but India has one of the worst records of dealing with poverty. And the poverty in the United States has increased. I don't think they have done enough of a study. And what is going to happen is the potential for social upheaval when there is this disparity. And that is going to come to haunt us. So, that's the point I want to raise, that's a big factor.
I think that's very true. I don't think there's any question. I think we're going to run out of time. So would you do me a favor and pass the microphone right behind you first, and then we'll go over to this side of the room. Just bear with us just a minute.
Good morning, Jeffrey Milton. A word we haven't discussed this morning, stagflation. Yesterday's FOMC, there's one member who doesn't agree with the interest rate policy. Gold shot up to, I think, 1290 this morning. Is it something we should be thinking about?
No?
No.
Can you explain the gold market then?
Well, I'll take. Do you want me to address that
Archie,
quickly? Yeah,
Archie,
go
I
ahead.
just want to let you know, give you a 2-minute warning,
I know
and I
that,
like
but-
good terse answers like that.
Okay, right. One question.
Peter?
Peter. There's a microphone right there.
The populist rhetoric is obviously going to increase until the unemployment figures work down. What policy prescriptions do you recommend?
Well,
An easier question.
okay. Well, here's in 2 seconds. We're running out of time.
One
I'll tell
that
you-
Washington has
I'll
been
tell you
searching
mine.
for
Mine-
some time.
The few people I talk to in Washington, my argument has been that we want to forget policy aimed at the early cycle, forget housing, forget autos, forget that. That's where the credit oriented. That's where the bubble was. You can't reflate bubbles. What we should do is reward investment put in place in the United States. Right? If you want to build a plant in the United States, there are huge tax incentives to do that. But it's got to be investment, and it's got to be put in place in the 50 states. I think that's been my.
Yeah, I'll just give you a few. One, don't raise any taxes now. Extend all the tax, postpone any tax increases for at least 12 months, if not 18 months.
Except for healthcare, which is going to happen anyway.
Well, I just say, again, right now,
Right.
raising taxes is a bad idea. Two, conventional mortgage rates are now incredibly low, like the lowest they've ever been, but many people are not having access to that. And I think a program through Fannie and Freddie that actually gets lower look where treasury yields are. They're around 2.5% in 10 years. If you actually could transfer that benefit, allowing refi, there's actually very little refinancing's gone on compared, in other words, the outstanding mortgage rate that people are paying versus the conventional is very wide. The amount of refinancing is very small. And third, the administration talks about exports, but no free trade legislation has gone through under this administration. After the previous several, including, Clinton administration, there was lots of free trade legislation. That will help. I think those are the three things I would say.
There's a question over here, if we could get the mic over here.
It seems that there are two elephants in the room that nobody wants to discuss. I'm pulling Kirschenbaum. One is the President Obama mentioned the $500 trillion derivative issue, which was reduced from over 1 quadrillion, which was the Bank for International Settlements number. Number one, how are we going to deal with that issue in the financial industry? How is it going to be written off, serviced, earned? And the other issue seems to be the problem that stems from the naked shorting, with the tremendous increase in shares outstanding, which we have to still divide by earnings per share. These seem to be two very current problems that nobody seems to have mentioned. Could you kindly comment on both of them?
I can very quickly. Naked shorting. Mary Shapiro spoke here in New York about a week and a half ago or 2 weeks ago, and my guess is that the SEC will be dealing pretty harshly with the issue of naked shorting probably in the next several months. That's my read. That's not a fact. That's my opinion. Listening to her speak. The other was derivatives. Look, I think that if you look at the financial sector's lending, for most of this decade, they were lending to other financial institutions, right? We were just whipping it around and whipping it around, whipping it around. That manifests itself more than any place else in the derivatives market. I personally, this is my personal belief, is the derivatives market is way out of control. It is not being used for the purposes that every academic suggests that you have a derivatives market for. And I think it's become dysfunctional. I think the financial sector is sucking, much as technology did, sucking capital away from productive use. And I think the shrinkage of the financial sector would be one of the most healthiest things we could do for the global economy, to be perfectly frank. I know Archie probably doesn't like hearing that given his role. But
Richard
I
used to
really
work for a bank, now he doesn't anymore. So now
No,
it's-
I actually said that at a bank, which is, maybe people should have listened a little more.
I'm just a contrary view. I do not think that derivatives are a big problem. They may be being overused, but they are not it's not a big credit exposure issue.
No, I agree.
Okay, I think we've got one. I don't know if we have time for one more. You had a hand up in the back for a minute.
Quick question for the board. It's been a great discussion, by the way. Does anyone anticipate a bubble in the gold market or the bond market? And just part and parcel of that, if I've got a commercial note that I've got to refinance and resets a year from now, should I try to do it now or let it wait for a year? It indexed to 5-year treasuries.
I'm going to say, as a non-expert in these matters, but it's hard to imagine rates going down anymore. Therefore, if one has an option of refinancing, this seems like a mighty good time to do it because the odds are that they're going to go up rather than down.
Good answer.
Sure. Yeah, on the gold question, I'm not a gold bug. I really have no view at all.
Well, I'll try for 2 seconds. I think one of the signs of a bubble is it pervades society, right? We call everything a bubble these days. Just speculation becomes a bubble. But the real history of bubbles is they pervade society, right? Like people were leaving their jobs to go become real estate agents, right? People were leaving their jobs to go be day traders. You're not seeing that in the gold market really yet. But I will tell you, there is a barbershop on 6th Avenue around 14th Street that has a sign that says barbershop, and underneath it says, "We buy gold." So something weird is beginning to happen.
Thank you very much.
Thank you all.
To our panel.